Hello, everyone. Here with us today is Mike Jungen, branch manager for RedZone Mortgage, with 22 plus years of experience. Mike, how did you get started?
I was kind of forced to by my mom back in the day. I started in the industry when I was 14 years old. I was working as a paper pusher file boy for a subprime mortgage group that my mother was the vice president of.
Oh, wow.
And I would work there in the summers. And every summer I would kind of get a little bit more knowledge. So I went from file boy to assistant processor, and then they realized that I was good at talking with people. So then they had me cold call bankruptcy papers.
Oh, my.
So people that were coming fresh out of bankruptcy, seeing if they were interested in getting a new mortgage.
Oh, wow. That is.
And yeah, that was a little difficult. I don't think I had the best success rate at that, but it definitely warmed me up to understanding people's plights and what they go through and their financial situations and whatnot. And then when I became 16, I got licensed with the state of Texas as a originator. And I was that was way back in the day when you didn't have to take a test. That was You just had to sit in on a weekend course, and I literally had to get a permission slip signed from the state of by my mom for the state of Texas to be licensed that young.
Wow.
So that's how I got drug in here.
That is quite a
shout outs,
resume.
shout outs to mom.
Right, right. So let's get down to it. What is the home buying process?
So the home buying process, if you're like a first time home buyer, a lot of people just wonder like where to start or where to begin. We tried to make it a streamlined process for everyone. What I like to tell my buyers is that it's a two-step program, two-step process. Step one is filling out a quick application online. Generally speaking, we're only looking for your last 2 years of residence history and your employment history. And so step one is filling out a quick application. And step two, that's sending in your income documentation, whether it's pay stubs or your tax returns if you are self employed. And that allows us to calculate people's buying power, lets us show them what loan programs that they qualify for. And if you are a first time home buyer, then we can see if we can get you qualified for any down payment assistance to the state of Texas. We are currently signed up for, I believe I've got us at 4 different assistance programs that the state has to offer. So we will run the gauntlet, and once we get all that information, uh, show you what you qualify for in the form of a presentation. And if you are comfortable and like what you see, then we will proceed to the next step, which would be going out, pinging you, shopping for homes, using your expertise, and getting the best deal.
Very good, very good. And what do you say are the components to a complete transaction?
Components to a complete transaction. What really helps is if the potential buyer gives us all the information that we need at the first go. Um, but key components. Uh, well, let's take a step back. So not from the buyer's perspective, but key components to a transaction, like what's making a transaction run. You're going to have three, in my opinion. That's going to be the lender, the realtor, and the title company. The lender, that's who's going to that. In my opinion, going to a lender first is step one.
Mm-hmm.
A lot of people get a wild hair and they start looking at houses online because they want to buy a house after they stop renting, and it's kind of putting the cart before the horse. Where you don't really know what you qualify for. You may get your hopes up. You might see these awesome houses online, but you may not qualify for them. So step one would be to go to a lender, make sure you get a pre-approval or a plan of action. Plan of action to get approved. Not everyone that applies instantly qualifies, and some banks out there that are larger that may have rocket ships, maybe they don't care about those consumers because it's a numbers game, and they move on to the next one. Here at RedZone Mortgage Group, what we do is we help people get qualified if they're not qualified. So we'll create a plan of action. It might be 2 months out, it might be 6 months out, it might be a year out. It doesn't matter. So step one, get with your lender. That would be your entity number one. Um, Once we have done that two-step process, then they would go to you. or your second component to a transaction, by far the one that's holding it all together is definitely going to be your lovely realtor. Um, they are going to be the ones that go out and show you homes on the weekends. They're going to be helping you put together lists of houses for you to see in the evenings. When you're off of work, that's when y'all are working.
Yep.
You're working on the weekends or working on the evenings or working holidays sometimes. So it's really important, in my opinion, to make sure that we have a qualified buyer talking to you,
Right.
so they're not wasting your time. If you see something online and you just call up a realtor and you don't have any pre-approval and you don't know the parameters of what you can buy, um, and your realtor doesn't know that right off the bat, um, you could be setting yourself up for some heartbreak. You might want to see a house.
Oh, yeah. And there's no easier way to set yourself up for a heartbreak than going shopping before knowing what your borrowing power is.
Yeah.
So,
Yeah. So your realtor, that's definitely going to be the second biggest component to a transaction, and third, last but not least, that would be the title company that you close at. And so you might see a bunch of title companies when you drive, Title Max or Lawyers Title, Capital Title. Title companies. There's good title companies everywhere out there, but a title company, what they do is they put together all of the components to a transaction. They are going to be making sure everything is legal. All the government instruments are recorded and document, making sure that your name is the one that's attached to this house, making sure that the title of the house that you're purchasing isn't clouded. Maybe it's in a trust or something of that nature. Maybe the seller isn't aware that maybe the seller is deceased, and the estate of the seller, of the deceased seller, may have some children or some family ties that aren't wrapped up yet. So the title company, they make sure that those ties are wrapped up, that you're getting a house that is free and clear title in your name, and they also put together they pay out all the parties of the transaction. So um, they're going to pay the county property taxes. They're going to pay the realtor. They're going to pay the seller, of course. They're going to pay any third parties that are involved with the transaction and getting you to the finish line. The title companies, I mean, the three components are all important, but
yeah.
We as a lender and as a realtor, we can only be as good as the title company that we work with as well, in my opinion. And so, Capital Title, Lawyers Title, Allegiance Title, these are companies that have outstanding track records, fidelity backed title companies as well, where, if there's a delay, that they are on top of it and they inform all parties at the same time, including you, the buyer. So,
exactly.
yeah, without a title company, we would be very lost.
For sure. And they make sure that all T's are crossed, all I's are dotted, so that you, the buyer, can rest assured you'll have a clear title at the end of this transaction.
Yeah.
Mike, what programs do you offer?
So I like to say we offer every program you can think about, every program under the sun. So there's four major programs that are the most common. Those are going to be your government loans and then your conventional loans. So to put it easily, uh, there's four. So there's going to be three government loans that we offer. There is FHA, Federal Housing Administration, HUD. There's VA, Veterans Administration loans, and USDA, agricultural loans. That's just like it's just like it sounds like the meat selection that you get at the grocery store, USDA. So you've got those three government programs, and you've got conventional. It's going to be you may hear on the news Fannie Mae, Freddie Mac. Those are going to be your private type loans, where the guidelines are different than your government loans, and so we offer those four major ones. Those are probably, I would say, 80% of the transactions that we close. One of those four. Um, FHA government loans, those are going to be a little bit easier to qualify for. They are I would say, geared more towards first-time homebuyers. An FHA loan, for instance, they have they're not so hard on people's buying power. Where a conventional mortgage, for instance, Fannie Mae, Freddie Mac, they have requirements and interest rates are staggered for every 20 points. So, they go as low as a 620 in most instances. So 620 to 640, 641 to 660. So for each tier, you're going to have a different interest rate. Whereas with FHA, with VA, with USDA, you're looking at about 4 tiers stemming as low as 580 all the way up to 850.
Wow.
So it's a little bit easier to qualify with the income you may make. They're a little bit more lenient with the interest rates. So you may have a more attractive interest rate. But no matter what loan we're talking about, if it's FHA, VA, USDA, conventional, it's all kind of differentiated by the type of mortgage insurance that is on the loan. Mortgage insurance, everyone's favorite topic. Mortgage insurance, in my opinion, the best way to explain mortgage insurance is it's how the bank protects their butt. Heaven forbid someone goes in default and can't make their monthly payments, or they're facing down foreclosure. What mortgage insurance does on any type of loan, mortgage insurance protects the bank's butt. So that means, heaven forbid that happens, when the property is relinquished, the bank will be made whole for the portion that you were not able to pay. So mortgage insurance is on all four of those different loan programs. It's just it's cut a different way. For instance, FHA has two mortgage insurances. You have a delightful monthly mortgage insurance, which actually just got lowered.
Oh, nice.
Yeah, it's a set rate based off of the loan amount. So it doesn't matter what your credit score is, which is extremely nice. You can have it down to a 580. You have an 850. Mortgage insurance is going to be just a set rate. So you've got a small monthly mortgage insurance that just got lowered, which is great. And it also has upfront mortgage insurance. And basically what that looks like is it's a small percentage of the loan. These are all percentages of the loan amount.
Right.
It's a small percentage of the loan, and it's rolled into your loan amount. So you've got a little bit up front that's not required to be paid at closing. You've got a little bit up front, and you have some monthly. So FHA has two forms of mortgage insurance. And what mortgage insurance essentially does is the reason why it exists, protect the bank's butt, yes, but it also, these government loans, they're offering lower rates than normal usually. So the mortgage insurance helps keep the program afloat and allows for the next person, the next person, the next person to also benefit from an FHA loan.
Right.
So you have FHA, mortgage insurance is in two spots. USDA loans, they are rather unique. They are trying to stimulate people from moving out of the major metropolitan areas. So there's a good old map, interactive map, USDA eligibility map, and basically you plug in an address, and it'll spit up, DFW, for example, and everything that's in this orange color, you cannot. It's not eligible for USDA financing. The further you get outside of DFW, your Little Elms, your Red Oaks, your Kaufman County-ish areas, those are going to be USDA eligible areas, which a USDA loan is very attractive because you don't have to have any down payment. All you worry about is closing costs. So there's no down payment required. FHA typically is going to want 3.5% of your loan amount. USDA, nice cut and dry, 0% down payment required. Just you're covering the closing costs. So USDA is similar in FHA because it does have a smaller upfront mortgage insurance than FHA, and it also has a monthly mortgage insurance as well. So FHA, USDA both have two forms of mortgage insurance. VA, veteran loan. Thank you for your service, veterans out there. I grew up in a military family, so I take a liking to VA loans personally. VA loans also have mortgage insurance. However, that requirement is waived if the veteran is receiving any sort of service-related disability
Hmm.
compensation on a monthly basis. So, USD loans, I'm sorry, VA loans are
Hmm.
great because they require 0% down payment.
Yes.
You can utilize a VA loan anywhere. There's no cap on the purchase price for VA loans. There is a cap on FHA. There is a cap on USDA. That's kind of income related.
Hmm.
But VA, if the veteran can qualify for $1 million house, if the veteran has some service related disability, there's no mortgage insurance involved. They just have to worry about closing costs themselves.
Hmm.
And there's slightly less closing costs on a VA loan than others.
Right.
But that's a great product. And in the great state of Texas, of course, if a veteran has a 100% service related disability rating, then you do not have to pay property taxes whatsoever. So,
Oh, yeah, there's definitely a lot of benefits
mhm.
for all of our men and women that serve or have served. Same thing with inspectors. We have inspectors that will definitely give us a discount for getting those properties inspected,
Yeah.
appraisers, you name it. I mean, there's just so much out there
Mhm.
for all our men and women.
Yeah. And a VA loan, you can. VA loan is all about entitlement. So if you're a first time VA, if you're a first time veteran using, let me say that again. If you're a veteran, first time homebuyer, you have entitlement
Hmm.
and you use that entitlement to purchase your house. And whether you've been in that house for 5, 10 years, you still have remaining entitlement left over, usually. Talk to your lender. But where I'm going with this is that sometimes, in some instances, you can utilize a VA loan for a second home
Yeah,
and have two VA mortgages at once. FHA, that's not the case.
right.
USDA, it's probably, I would say, not impossible, but I've never seen it in my
Hmm.
tenure. Um, but an FHA loan, you have to have a certain job requirements. Maybe the job is shipping you 100 miles past where you currently live, and
Right.
so you have some stipulations. But
Hmm.
with VA, VA is by far probably my favorite loan to work with
Yeah.
because it's easy to connect with the veterans. It's easy to show them that they're getting the best deal out of all these
Oh,
loan
yeah.
programs,
Oh, yeah.
and everyone's just really working to benefit the veterans. So
Correct.
um, you only have mortgage insurance up front. If you don't have a service related disability, you do have a small percentage of mortgage insurance that's upfront, not monthly. And last but not least, conventional financing. Conventional financing, you're probably a repeat home buyer, or you probably have if I have a first time home buyer that wants to look or entertain conventional financing, I would say, let's probably do that if we're have above a 700 credit score, for instance, um, because circling back to what I was saying about those tier systems when it
Hmm.
comes to interest rates, um, not only is it for every 20 points you're going to have a different interest rate, but also monthly mortgage insurance. Monthly mortgage insurance is going to be affected by your credit scores as well. There's a lot of things that factor into mortgage insurance for a
Yeah.
conventional mortgage versus FHA, USDA, VA.
Right.
Those are set uh, percentage rates with those government programs. For conventional, it's all over the board. If you put down, you have a 720 putting out 3% or putting out 5%, that's going to change the amount of mortgage insurance. I guess a better way to say that is mortgage insurance is basically an assessment of risk.
Mm.
That's really what a mortgage is. When you're qualifying for a mortgage, you're assessing risk, and that's the bank's. If someone's putting down 3%,
Right.
which is the minimum
Hmm.
down requirement, they are more at risk
Right.
than someone that's putting 20% down. You just have more skin in the game,
Yeah. Correct.
and that's something that I deal with very commonly from first time homebuyers is for whatever reason they have a misconception that, oh, I got to put 20% down.
Yeah.
And I don't know where they hear that from, but 20% down for sure, that's great. If you have 20% down, do it. Awesome.
Yeah. Well, that more or less that was the rule of thumb back in the day.
Mhm. Yeah. So yeah, 20% down is definitely not a requirement. If you want to avoid mortgage insurance altogether, yes, that will definitely help you out. But you don't have to put down 20% on a conventional loan to eliminate mortgage insurance. Mortgage insurance is monthly on a conventional, but you have options. So that's kind of what the
Right.
beauty of
Right.
a conventional mortgage is that um, you can have monthly mortgage insurance. You could uh, eliminate mortgage insurance up front by paying for it at closing. So the conventional vehicle is a great way to no longer have mortgage insurance, even if you're putting down 5%. Um, it, so you have that option, or you can split mortgage insurance.
Oh,
You could maybe put down, not buy it all out up front,
right.
but you could put maybe $2,000 or $3,000 down up front and have a smaller monthly mortgage insurance payment.
Oh, I never knew that.
Yeah, so there's a lot of different
Huh.
ways that you can cut it. So conventional and mortgage insurance. Um, Now, realtors love conventional loans.
Yes.
Why is that?
The flexibility. Um, our sellers are more open to dealing with someone that has a conventional loan because there's less hurdles, there's less hiccups, typically, not
Right.
all the time. So, conventionally is usually the way they want us to go.
I understand, and I would love to be able to educate sellers a little bit more as to what those hurdles they think maybe really are. Um, when it comes to government loans, like FHA, VA, USDA, um, they have a bad stigma against them, or they did at
Yeah,
least when houses were on the market for 2 3 days max.
right, right.
But the stigmas that I hear from a lot of first time home buyers or sellers or realtors about these government loans, they don't really necessarily. I mean, they're going to apply to conventional as well. So, if you have cracked windows, if the seller is trying to sell a house that has cracked windows, some of the doors they may not lock, uh, plumbing is not working, exposed wires
Hmm.
around outlets. Well, those things are going to need to be replaced, no matter if it's replaced or fixed.
Right, right.
For safety concerns, if it's an FHA, VA, USDA, or a conventional loan. So it's not like FHA or VA have anything additional that they like, except for the following: FHA, if you have concrete floors, you're as a seller, you're just going to not want to accept a, a an FHA offer because you're going to have to
Put the floor down.
put the floor down. So, and
Yeah.
this is exposed concrete floors. If you have concrete floors and you have something on top of it, perfect. But if you have concrete exposed floors, then that's going to be an issue. So
Right.
there's that small caveat about FHA loans. And then for VA loans they don't like vines.
Oh,
So if you have a pretty wall that's got vines growing on the outside, take them off. Take them off. The only caveats I've ever had on VA loans: vines and pool decking. Um,
oh, okay.
Basically, VA is a little bit more concerned with rot, wood rot.
Okay, makes sense.
So vines can cause that. Of course, exposed liquid damage. But outside of that, I mean, you're probably not listing your house for sale if you have those problems.
Yeah.
Unless you're trying to target investors and just completely wash your hands.
Right,
That's a
right.
different type of story. And typically, your first time home buyers probably not going to want to fix her upper like that.
Correct.
So, you know, a conventional mortgage is great, but it's no reason not to accept, from a seller's perspective, a VA loan, an FHA loan, or if it does qualify for a USDA loan. And the only other stigmas I've heard about is, well, if it appraises low, then we're screwed. We're stuck with that. It's not the case. If someone's buying your house FHA or VA and you're gunning for a 310 sales price and it comes back at 305, if the buyer wants that and the seller doesn't want to come down off the price, the buyer can make up that difference. Um, so there's not really you know, any, no one's saying no to that. No one
Right.
here at RedZone Mortgage is saying no. If you want,
Yeah.
if the house doesn't appraise for what the sales price is, and you still want that house, and you have a gift or that money
Hmm.
to cover that delta, we're going to fund that. So don't sellers saying, oh, it's a VA loan and we're kind of at the top of our price point, so I'm scared to accept that offer. I mean, it's basically you're going to get your money in a plastic bag or a brown bag. I mean, same amount of money, same sales price you're walking with. So
Yeah.
it's really not. It shouldn't be detrimental, or it shouldn't be have the stigma that it does. That's a little unfortunate. So I like to
True.
help realtors kind of understand that just no vines, no concrete.
And we're good.
Yeah,
And we're set.
quality deal. Yeah,
And what do we need to qualify for any one of these programs that you have available?
a pulse.
Excellent. We're good.
Yeah. No. So when people are qualifying, there's each scenario is different.
Mhm.
And so people aren't just numbers, people are scenarios, and we try to make every scenario work. So we one thing that goes a long way is credit score. Everyone thinks, okay, well, I got 700, I instantly qualify for a mortgage, this, and the third. Well, there's other things that are involved for sure. 1A, I guess you could say, is credit, but 1B would be your debt to income ratio.
Yes.
And
Yes.
that's a big deal. That's how much you qualify for. That's your buying power. Your debt to income ratio is a simple formula that is basically your current monthly obligations that are on your credit report. We're not talking about childcare expenses. We're not talking about your cell phone bill. We're not talking about utilities.
Right.
We're not talking about insurance. We're talking about credit cards, liabilities, autos, other mortgages you may have. So your debt to income ratio is your current monthly being the key term, not your total sum, but the monthly obligations plus your future house payment divided by your monthly income. So a lot of people that are fresh out of school, recently graduated, uh, I'm going to pick on my wife a little bit. Um, she had $300,000 in student loan debt.
Oh, wow.
And she never thought she could qualify for a house until years and years and years down the line. Well, she, and like many people that are in the medical profession, was in an income-based repayment plan where your loan servicer, your student loan servicer, knows that you are $300,000 worth of debt, but you're only making $75,000 worth of income. They're going to put you in an income-based repayment plan. And so we take, as long as we can prove that the income-based repayment is what it is on the paper, we verify that with with your loan servicer. We can use that smaller monthly payment. So, um, you know, people that do have excessive student loans, if they're in an income-based repayment plan, we can still work with you, and we can probably get you qualified for that house that you want. Um, People that aren't in the medical profession, that aren't an educator, um, if their student loans are deferred or in forbearance, I know that's pretty much everyone right now due to the government still trying to work out these COVID, regulations and whatnot. But we'd simply just take the sum of what you owe, $200,000, $300,000, and multiply that by 0.5%, 0.005. We count that against you in your monthly debt obligation.
Oh, okay. Sounds easy.
Yeah, so just a little simple math. Your total lump sum of your student loans times 0.005, and we count that against you monthly. So your debt to income ratio is huge because 1A is credit, 1B is your debt to income ratio, and typically you're not going to want to go, once you plug in your obligations, once you plug in that future house payment, once you divide that by your monthly income, the product of that you want to be on average below 45%. So you don't want your future house to exceed your future house plus all of your other obligations. You don't want that to exceed 45% of your income. Now that's pretty much like I'm talking to you like a conventional.
Hmm.
I'm talking to you from like a Fannie Mae Freddie Mac standard. FHA, the buying power, they give you a lot more buying power. They're a little bit nicer on the debt to income ratio. So in some instances, with great credit, you can go up to as high as 56% debt to income ratio. Um, there's compensating factors that help out with that. With VA, I've got veterans. That's high. The highest debt to income ratio I've ever closed on was a 72%
Wow.
debt to income ratio. Of course, there's compensating factors.
Right.
If you have a lot of savings accrued, if you have excellent work history, so it's all just a case by case scenario. You can't just say this is the bucket that I need you to fit in, because everyone has a completely different revolving parts.
Oh yeah.
And it's important that you're dealing with a lender, in my opinion, that recognizes that, because you can submit your life on in the form of an application to these larger banks, and they're going to spit out a pre-approval for you because they're not doing the due diligence. They just see
Hmm.
credit score, they spit out the pre-approval letter or the pre-qualified letter,
Yeah.
and they're like, okay, well, I'm gonna go, I got this, I'm gonna go shopping. But it's not until a human being, an underwriter, has to take a look at your whole entire scenario.
Yeah.
And that's what we do up front. We look at everything up front, as opposed to just filling out a quick application and then say, okay, go shop, because we want you to keep your earnest money. We don't want you
Right.
showing people houses when they're not truly qualified,
Yeah.
because we didn't ask for their tax returns and they have an IRS payment, or we didn't see their pay stubs and didn't notice that they're making child support payments for an additional $400 a month. Those things, when those things come to light after someone gets under contract, that can be like a little mini train wreck.
Oh yeah.
Now we're calling up friends and family for help, and
Oh
maybe
yeah.
we can't get that help. Maybe we are now, you know, we just want you to keep your option money, your earnest money. If you so,
Yeah.
I could go on another tangent, obviously.
No, and we see that a lot more than we'd like to. Some of my buyers are concerned to have their credit pulled by multiple institutions.
Mhm.
And I know some banks offer like a soft pull. Could you explain what that is exactly, and
Yeah,
is it beneficial to us?
yeah. So there is a difference. There is a soft pull and there is a hard pull, a hard credit pull. Um, Now, when someone is shopping for any item, a mortgage, an automobile, credit card, um, we the credit scoring system is not designed to punish the consumer for looking for the
Okay.
best deal. So you typically are going to have a 45-day window where, at least in regarding mortgages, a mortgage pull, yes, a mortgage pull is a hard pull. By hard pull, what that means is that it will uh, probably pull your credit score down by 5 to 10 points. Um, and if you do that on day one, you have, I mean, you could talk to 20 different mortgage companies, have 20 different mortgage companies pull your credit. If it's within that 45-day window, the only score impact you will see will be based off that first one.
Oh, okay.
Now, if you are shopping in multiple industries, so if you're looking at an automobile as well as a mortgage, maybe looking at a credit card as well, multiple inquiries across multiple industries, that can damage your,
That will.
that will pull you down.
Yeah.
So you want to keep your shopping to one thing at a time, for lack of better words. Um, but we do also have the ability to run a soft pull on you, and a soft pull is exactly what it sounds like. You're not going to get dinged on your credit. Um, it does hamper the this, the approval ability of the lender. I can't. I mean, I guess I could, but if I'm being a really good loan officer, I'm not going to just do a soft pull and be like, okay, you're off to the races. Uh, but a soft pull will, then we can enter the conversation about, okay, you have everything, you have all these good items working for you. Your credit score on the soft pull was 745. I do recommend we pull this to a hard pull, and that way we can get you a full blown bona fide approval.
Right.
Um,
Right.
because yeah, it's just there's a difference between a soft pull and a hard pull. And the soft pull, it's a good litmus test to see where we're at. But in order to get a hard approval, we need to do that hard pull.
Yeah.
And typically, the score impact of 5 to 10 points for that hard pull, that's not going to affect your interest rate pricing, because the interest rate pricing is either, if we're talking about an FHA loan, we're talking about increments of 40 to 60 points in those buckets. If we're talking about a conventional loan, it's 20 points. So if you have a 745 and we pull your credit and that brings you to a 740, I mean, you're still in that 740 bucket for interest rates. And your credit's going to heal after 90 business days. So assuming nothing else, assuming you're still making your payments on time, assuming you're not getting multiple inquiries across multiple industries, then your score is going to heal. So it's not that big of a deal, and it shouldn't be anything that deters you from wanting to test the waters, because it's all going to heal.
Right.
Time heals all wounds.
That is very true. Mike, how can we reach you? We're ready to get started. We're ready to go shopping for our dream home, but we don't want to do it without our pre-approval. How do we contact you?
Well, smoke signals, personally, I like.
I can do that.
Okay, cool. We like smoke signals. We are online. We are online at redzonemtg.com, www.redzonemtg.com. Like M as a mortgage, T as in team, G as a group. We're on the Facebooks. We're on the Instagrams, #RedZoneMTG. We do have a team hotline where, if you are out and about on the weekends shopping and you have some questions, we're here to provide you that coverage. That you can call and or text 214-600-8001. It doesn't rhyme like a Mike Jones song, but 214-600-8001. You can reach us that way, and we will return your inquiry as fast as we can.
All right, excellent. Mike, thank you so much.
It's a pleasure. Yeah, absolutely. Thank you. Cool.
All right, we'll talk to you guys soon.